Hello everybody, it's another week. Right, let's start. This is the United States of America and it's a Jim Bianco chart giving us the short-term interest rate going back to 1831. There's a grey line coming down just to the left of middle there. I've highlighted Federal Reserve created, which was 1913, I think. And to the left of it, it was very up and down what the short-term interest rate might have been, but it was quite high. And after the Federal Reserve was created, it was a lot more stable. So let's follow it from 1913, because America bumped very soon into the Great Depression, 1930, and you can see the interest rate was basically brought down to the ground, which ran into the Second World War, and the interest rate was left right down on the ground all the way to about 1947 by the look of it. And then it swooped right up to early 80s, which was the oil crash and all that inflation, Volcker getting it under control in the early 80s and bringing it right down now to Bear Stearns, Lehman, and European sovereign bond crisis, where it's back down on the deck again. Okay, let's move on. This is more up to date. It only goes back to 1987, but there has been quite a lot of economic hiccups since 1987, with the stock market crash being one of the bigger ones that caused cross-border equity portfolio flows crisis periods, and the stock market crash really brought it down below that grey line. Now there have been coming downs below the grey line, but not as deep as the stock market crash highlighted there, which was late 87. Gulf War just brought it down a tickle below the grey line. ERM crisis didn't even bring it down to the that line. That was John Major and Soros. Peso crisis brought it down below the Asian crisis, then the Russian crisis. Even the terrorist attack on the US, yes, didn't bring it down, but US corporate scandals, that'll be Enron, did bring it down. Iraq war put a dent in it, but didn't bring it anywhere near the grey line. Subprime crisis, now we're coming into 2007-8. We're talking Bear Stearns here, the first one, but then Lehman Brothers really danged it down much further than anything else. And since we've got a little problem, which should be the European sovereign debt crisis. Now, the estimate there from Nomura is that it's quite a lot lower than the red line. You know, it's coming down. Now, the article this is taken from basically says, look, it always goes back up again. But the point is that the Lehman bankruptcy that really brought it down, it was over and done with when Lehman was bankrupted. It had reverberations, but the main event was over. And the point for this is the European sovereign debt crisis is not over, and it's already in the red. So I don't really go with the main drive of this article that don't worry, things will come back soon enough, because the European sovereign debt crisis is not over. Okay. This is a good one from Cumberland Advisors, and I might use some more charts from this PDF later in the week. I'm calling this a Batman chart for me. I mean, my mystic brain looks for these things, obviously. Can you see Batman in the middle, in green and the purple, with his arms open, his wings about to fly? Anyway, besides that, we can see these are the main central banks of the world. The Fed in blue at the bottom, the Bank of England in red, the ECB in green, and the Bank of Japan in purpley at the top. We can see that those four together in 2006, where the chart starts, were under $4 trillion worth of assets on their books. And via Batman and General ramping up, are now at 8 trillion. They've taken on 4 trillion worth of assets onto their books and swapped those assets, which are cash flow products, for actual cash out in the world. So there's 4 trillion worth of actual cash where there was just potential cash flow assets. And there's no sign of that stopping. The ECB is the one that's cranking it up the most now, but the Bank of Japan's doing its stuff. And actually the Bank of England isn't doing too badly, but it's only a small bank compared to the other 3. But it looks to my eye as though the Federal Reserve, it's slightly down at the moment, and those swaps that were announced a few weeks ago will start biting, and that will start going up again. And if that doesn't go up again, I would imagine that the Fed will start ramping again quite soon. Early next year, this needs to keep going up and up and up and up due to many things, which we haven't got time to go into. But these have got to rise, and the Fed isn't doing its thing at the moment and will need to get back on the ramping up, which is, as I say, creating money out of thin air, but then buying something from the real economy, which is a cash flow asset, bringing the cash flow asset onto its books and replacing out there with cash. Generally, what's always happened with these central banks is that cash is then returned straight back to the central bank and left on the central bank's books as a reserve asset for the bank that sold the cash flow product. The money isn't getting out and circulating in the real world. Right. So why it's not getting out and circulating in the real world? Now, it doesn't matter where this is for, but what we have in black are credit standards at banks. And we can see it was low when we came into this chart in 2003 from the 9/11 extension of the dot-com crash. So banks were not lending. Banks are the conduit for lending money into the economy, increasing the amount of money in the economy. And if their credit standards are elevated, not much money gets out into the economy. Over 50, it means their credit standards are lax and money is getting out. And they loosened up for late 2003, going up into 2007. But then Bear Stearns to hedge funds went and subprime, and they go, oh jolly heck, and really crunched in again on lending standards. And that was all the way to 2008. And then they got the idea, okay, things are going to be all right, and started letting the credit standards loosen off again. But they have always been below 50. In other words, they've been tighter than what we could call average ever since, certainly ever since the Bear Stearns incident. And they are heading down again. In other words, credit standards are tightening again in banks. The red line is the PMI composites that I go on and on and on about, of this above the 50, below the 50, various countries in the world. They follow the bank standards, as in bank lending standards comes first, PMIs come second, which is a group of things that say how good GDP is going to be. So if we take PMIs out, we can even say that credit standards lead GDP up and down. Banks stop lending, GDP goes down. Banks lend, GDP goes up. Banks. That is what GDP is. Let's even cut out everything else. Bank lending is GDP. It's not that direct, but I'm the mystic and simplifying. Right, this is from an Edward Hugh article about Finland, which I love Edward Hugh except his chart, and very interesting because we think of the Scandinavians always doing brilliant things. Finland, if you've got to read the article, but this is all part of the Euro sovereign debt crisis, and Finland would normally be put on the definite core side, but they're looking a bit wobbly. And if we look at this chart, one of the reasons here is from the middle chart there, which starts at 35 and goes up to nearly 45 from 1990 to 2020. It's put out into the future. But it's Finland's medium population. It's aging. The population of Finland is aging. Now, banks know these things. They will not lend huge quantities of money to older people if the future is not bright. But if the future's bright, they'll even lend to older type people to bid up the prices of housing, etc. I'll read along the bottom. The level of aging is normally associated with low or volatile growth. Think Germany and Japan, heavy export dependent, or both. The country has an aging and declining workforce, and this, as the EU Commission noted in its most recent country forecast, which is worth a look, looks set to further take its toll on competitiveness and growth. As long as the banks can see that the country's cutting it by doing big exports or doing whatever it might be to keep a grip on growth and making it, even though they're getting older, they'll lend. But the slightest backsliding and they tighten up. And then as soon as they tighten up, what normally happens, even the exports start falling down, and it's a self-fulfilling prophecy that the country then is in terminal decline. Read along the top. So things are not too bad unless you take seriously my aging population's export dependency hypothesis, which I won't go into now, but you can imagine what it is, and if Edward Hugh has it, it's a goodie. In which case the recent loss of competitiveness is about to pose serious problems. That's for Finland. The country is now the 5th oldest, now we're going to open out into the world, on the planet, after Japan, Germany, Italy and Austria. Now, this is why Italy is getting crunched. The banks have always known, because actuarial tables can easily show you that's one thing that they're not going to get wrong, the aging of the population. But as long as things are all right and there's some special little thing going on in the country, they'll keep lending. But they're keeping an eye on this, and as soon as it starts, they put the brakes on, and then that country is effectively finished. Japan has kept it going. Germany's keeping it going by this great export working hard, but they're always running up a hill of demographics. Austria obviously is the next one to be Pac-Maned and will get pulled down by their demographics, with the banks, who will notice they won't lend, and the whole thing will just go into reverse. Mario Draghi, the new ECB boy, interviewed by the Financial Times this morning. Will the 3-year refinancing operations give banks an incentive to buy periphery Eurozone bonds, which might be Finland bonds now, as well as as Finland slips into the periphery? This is the Sarko-Corzine trade. Borrow for 3 years from the ECB at 1%, and then do something with the money. But you've got to put the asset in there to get the money back. But you can kind of buy the asset first, put it in there, then get the money, and it's as though you're getting free money. Forget that last bit. Draghi says, not necessarily Corzine trade. Of course, banks also have capital difficulties, and these measures don't necessarily help on that side. It's just on the profitability that would work. The objective is to ease the funding pressure that banks are experiencing. They will then decide what the best use of these funds are. One aspiration is to have them financing the real economy, especially small and medium-sized enterprises. What we are observing is that small and medium-sized banks are the ones that are having the biggest funding difficulties, and they are generally the ones who provide most of the financing for the SMEs, and SMEs account for about 70% of the employment in the euro area's corporate sector. Unfortunately, all this the real stuff has to come through the confidence of bankers. That's money, and the money, extra money going into the economy is GDP up, restriction is GDP down, which then has a knock-on effect on governments, and then governments either do austerity or jog along happily. It's all so very much money and banks orientated. And the world is out there waiting on money. China November house prices are the worst of the year. New home prices dropped from the previous month in 49 cities monitored by the government, compared with 33 decreases in October. How is China going to deal with this money thing? They've got a lot more control, because it's not so much the psychology of the bankers about demographics, which aren't too clever in China. It's about what the politicians want. So the politicians will be able to pump out more money if and when necessary. They might be able to make the right decision at the right time. David Graeber, writing the UK Guardian, he's the fellow of the first 5,000 years of credit book, opens the article with this. It affects every aspect of our lives, is often said to be the root of all evil, and the analysis of the world that it makes possible, what we call the economy, is so important to us that economists have become the high priests of our society. Yet oddly, there is absolutely no consensus among economists what money really is. And this is, I'll do the second paragraph. Some see it primarily as a commodity traded against other commodities, others as a promise, an IOU, and still others as a government edict or a kind of ration coupon. Most see it as a kind of chaotic amalgam of all these. Economics textbooks, whose aim is to reassure us that everything is under control, boil money down to three things. It's a medium of exchange, a measure of value, and a store of value. The problem here is that economists can't even agree on the meaning of value either. I thought that's quite good, because that's where I come always back to the money and the value. And why does our local village have to lose its second district nurse that drives around in the car looking after the people? Because there isn't enough money. And why isn't there enough money? Nobody really knows. Those central banks can print it up any old time. But no, for some reason that nobody's really sure of, we can't have that extra money for that extra district nurse. She has got to go and try and get a job at a local supermarket or something. All for the lack of money, that we don't even know what it is. Bye.